This is Tuesday, February 10th, 2026, the last full trading week before the March contract delivery period begins. And what I'm about to show you is going to change everything you thought you knew about the silver market. Silver just crashed from $121 per ounce to $75 in a matter of days. Over $46 gone, a 38% collapse in less than 2 weeks. The financial media is calling it a speculative blow-off. They are telling you the bubble popped. They are saying the rally is over and you should move on. But if you are watching this and feeling scared or confused or thinking you missed your chance, I need you to stop, take a breath, and watch this entire video, because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. Let me say that again so it sinks in. The paper price of silver crashed 38% in 2 weeks. During that exact same 2 weeks, every major silver dealer in the world sold out of physical inventory. The United States Mint delayed the release of the 2026 American Silver Eagle from January to February 26th, and subscriptions are already completely sold out. Costco implemented purchase limits on silver bullion because they cannot reprice their inventory fast enough to keep up with demand. The Perth Mint in Australia, one of the largest and most respected mints in the world, is out of stock on multiple key products. The Royal Canadian Mint is out of stock. SD Bullion had fewer than 2,300 units left at last count and is warning customers of 2-week delivery delays. Pay very close attention to what I just said. The price is crashing, but you cannot buy the product. Does that make sense to you? Does that sound like a real market? In a normal market, when the price of something crashes by 38%, supply floods the market. Sellers panic. Inventory piles up. Dealers offer discounts to move product. That is how markets work. But in silver right now, the opposite is happening. The price crashed and physical silver became harder to find, not easier. Premiums over spot price widened to 12 to 15%. Delivery times stretched from days to weeks. Mints suspended sales. Something is very wrong. And by the end of this video, you will understand exactly what it is. My name is on this channel, and if this is your first time here, I analyze the precious metals markets with a level of depth and honesty that makes some people very uncomfortable. This is the kind of analysis you will not find anywhere else, because most analysts either do not understand what is really happening or they are too afraid to say it out loud. If you want to understand what is actually happening in the silver market right now, hit that subscribe button and turn on notifications, because what I'm about to walk you through is the most important precious metals story of the decade. A few days ago, I made a video. In that video, I told you that silver was heading toward a major inflection point. I told you that the registered inventory at COMEX was draining at an unsustainable rate. I told you that the March 2026 contract was setting up to be the most dangerous delivery period in modern history. I told you that the paper market and the physical market were on a collision course, and I was right. But here is what I did not expect. I did not expect silver to hit $121 per ounce on January 29th. I did not expect the CME to hike margin requirements 3 separate times in 1 week, forcing the most violent liquidation event in silver market history. I did not expect the paper price to collapse by 38% while physical demand accelerated. I did not expect the United States government mint to delay the release of their flagship silver product. I did not expect every major dealer in the world to run out of inventory at the exact same time while the price was supposedly crashing. And that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. There are 2 markets for silver. There is the paper market and there is the physical market. The paper market is where the price is set. This is COMEX in New York. This is the London Bullion Market Association. This is where futures contracts trade. This is where banks and institutions place massive bets on the direction of silver without ever touching an ounce of actual metal. The paper market is like a giant poker game. Players push chips around a table. The chips represent silver, but they are not silver. When the game gets too intense, the casino can change the rules. They can raise the stakes. They can force players to put up more money. They can even stop the game entirely if they want to. And that is exactly what happened in late January 2026 when silver hit $121. The CME raised margin requirements. They forced leveraged players to liquidate. They crashed the price. But here's the thing. Changing the rules of the poker game does not create more silver. It just changes the price of the chips. Then there is the physical market. This is where real metal changes hands. This is mints producing coins and bars. This is dealers selling to investors. This is industrial users buying silver for solar panels, electronics, electric vehicles, artificial intelligence hardware. This is where supply and demand actually matter, because you cannot deliver a futures contract. You cannot power a solar panel with a derivative. You need real metal. And right now, there is not enough real metal to go around. Here is what you need to understand. For decades, the price discovery mechanism for silver has been dominated by the paper market. The tail has been wagging the dog. 99% of silver trading volume happens in futures contracts that never result in physical delivery. The system only works as long as nobody asks for delivery all at once. It is a fractional reserve system. The same way banks do not keep all of your deposits in the vault because they assume you will not all show up at the same time to withdraw your money. But what happens when people do show up? What happens when they start demanding delivery? What happens when the poker chips need to be exchanged for actual silver? That is what we are watching right now. Let me show you the evidence. COMEX, the commodity exchange in New York, holds silver in two categories. There is eligible silver and there is registered silver. Eligible silver sits in COMEX-approved warehouses and meets all the exchange standards for purity and size. But it is not available for delivery unless the owner agrees to make it available. Think of it like cars in a parking garage that meet all the requirements to be sold, but the owners have not listed them for sale. Registered silver is different. Registered silver has been issued a warrant. It is actively available for delivery against futures contracts. It is the metal with a for sale sign in the window. As of February 4th, 2026, COMEX holds approximately 103 million ounces of registered silver. Let that sink in. 103 million ounces. That is the total amount of silver available for immediate delivery to satisfy futures contracts. Now let me show you the demand side. The March 2026 silver futures contract, which begins its delivery period on February 27th, has open interest representing approximately 429 million ounces. 429 million ounces of demand, 103 million ounces of supply. Does that math work for you? Even if only 20% of contract holders demand physical delivery, which is a conservative estimate based on historical patterns, that is 86 million ounces. COMEX does not have 86 million ounces. They have 103 million, and February deliveries have already claimed 13.8 million ounces with 2 weeks still remaining in the month. But it gets worse. Between early January and mid-January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. Let me repeat that. In just 7 days, 33.45 million ounces left the vaults. That is 26% of the registered inventory gone in 1 week. This is not normal market activity. This is a run on the bank, and the withdrawals have not stopped. They are accelerating. When metal is delivered on COMEX, it does not necessarily mean the metal is leaving the vault system entirely. It means ownership is transferring from one party to another. But when the metal actually leaves the vault, when it exits the COMEX system completely, that is where things get interesting. And that is exactly what has been happening. Metal is not just changing hands, it is leaving. It is going into private storage. It is going to industrial users who are locking up supply for their manufacturing needs. It is going to investors who want it out of the system entirely. Samsung secured exclusive rights to 100% of a Mexican silver mine's output for the next 2 years through a direct deal with the mine, bypassing COMEX entirely. Tesla has been reported to be securing physical silver through similar arrangements. These companies are not buying paper contracts. They are locking up the actual metal because they know what is coming. Now let me tell you who is doing what. This is perhaps the most important part of this entire video. Pay very close attention. American institutions and Western banks are selling paper silver. They are shorting futures contracts. They are liquidating positions. They are raising margin requirements. They are doing everything in their power to suppress the paper price and shake out leveraged speculators. Meanwhile, Chinese buyers are taking delivery of physical metal. Asian buyers are taking delivery. Middle Eastern sovereign wealth funds are taking delivery. Central banks in Russia, India, Saudi Arabia, and other emerging markets are accumulating silver as a strategic monetary asset. One side is playing a video game, the other side is taking home the prize. This is not new. This has been the pattern for as long as I can remember. The West treats silver as a derivative, a speculation, a number on a screen. The East treats silver as money, as a strategic resource, as real wealth. And right now, the East is calling the West's bluff. China designated silver as a strategic material in 2025 and imposed export restrictions. They are not allowing refined silver to leave the country. China used to supply 60 to 70% of global refined silver exports. That supply is now cut off. The market has fragmented. London and New York cannot simply order more silver from Asia to refill their vaults anymore. The arbitrage that used to keep global prices aligned is broken. Shanghai silver has traded at premiums of up to 10% over COMEX futures. That is an enormous spread, and it tells you everything about where the real demand is. Let me show you the technical indicators because this is where the panic becomes visible. Silver lease rates. In normal years, when supply is adequate, 1-month silver lease rates sit around 0.3% to 0.5%. These are the rates that bullion banks charge to lend silver to mints and refiners who need to borrow metal temporarily to produce coins and bars. By January 2026, lease rates had exploded to 8%. Let that sink in. 8% annualized just to borrow silver. Why would anyone pay 8% to borrow silver unless they were desperate? Unless they needed it immediately and could not get it any other way. This is a panic signal. When lease rates spike to these levels, it means the market is short of physical silver to an abnormal degree. Mints and refiners are struggling because borrowing silver has become uneconomical. Some have stopped production on less profitable products. Some are delaying shipments. The entire supply chain is under stress. And then there is the futures curve. Normally, longer dated contracts trade at a slight premium to near-term contracts because of storage and financing costs. That is called contango. But silver has been in backwardation, which means the spot price and near-term contracts are trading at a premium to future months. Backwardation is rare in commodity markets, and it signals immediate physical tightness. It means people are willing to pay more for metal now than for metal 6 months from now. That only happens when supply is constrained today. Let me connect all of this together for you. What we are witnessing is the breakdown of a 70-year pricing mechanism. Since the end of the Bretton Woods system, the price of precious metals has been controlled through paper derivatives markets. Massive trading volumes in futures contracts have dominated price discovery, even though those contracts represent promises, not metal. The system worked as long as physical demand remained predictable and manageable. But 5 structural forces have converged in 2026 to break the system. First, industrial demand is accelerating faster than mine supply can respond. Solar panels, electric vehicles, 5G infrastructure, artificial intelligence hardware, and medical applications are consuming silver at record rates. Global silver supply has been in deficit for 5 consecutive years. The 2026 deficit is projected to approach 200 million ounces. Second, China and other nations have reclassified silver as a strategic asset and imposed export controls, fracturing the global market. Third, central banks in emerging markets are accumulating silver alongside gold as part of de-dollarization strategies. Fourth, a credit crisis has emerged in the paper-silver system as investors lose confidence in the ability of exchanges to deliver physical metal. And fifth, leverage in the futures market has reached extreme levels, making violent price swings inevitable when margin requirements change. I believe we are approaching that breaking point. The March 2026 contract could be the catalyst. February 27th is first notice day. That is when contract holders must declare whether they are rolling their positions forward or standing for delivery. If delivery demand exceeds available registered inventory, COMEX faces a choice. Deliver whatever metal they have and drain the vaults to dangerously low levels, or settle contracts in cash and admit they cannot deliver. Either outcome destroys confidence in the paper pricing system. Now let me tell you what this means for you. If you are holding physical silver, you are sitting on the right side of history. Do not let the paper price crash scare you. The paper price is a distraction. What matters is that physical silver is harder to find now than it was 2 weeks ago when the price was $121. Premiums are wider, delivery times are longer, inventory is tighter. That tells you the real story. If you are holding paper silver, exchange-traded funds, futures contracts, unallocated storage, you need to understand the counterparty risk you are carrying. When the squeeze intensifies, some of those vehicles may settle in cash instead of metal. The fine print allows it. Read your contracts. Understand what you actually own. If you are looking to buy, understand that the window for acquiring physical silver at reasonable premiums is closing. Every major dealer is warning of supply constraints. Mints are running weeks behind on production. Sovereign coins are sold out. I am going to be very direct here. No sugarcoating. The best time to buy physical silver was 6 months ago. The second best time is right now before February 27th. After first notice day, if delivery demand overwhelms available supply, the physical market could decouple entirely from the paper price. Premiums could explode. Availability could dry up completely. You may not be able to buy physical silver at any price near the COMEX quote. Some people will say this is conspiracy theory. To those people, I say look at the evidence. COMEX registered inventory down 75% since 2020. 33.45 million ounces withdrawn in 1 week in January. February deliveries already at 13.8 million ounces with half the month remaining. March contract open interest at 429 million ounces against 103 million ounces of registered supply. Lease rates at 8% when normal is 0.5%. Shanghai trading at 10% premiums over COMEX. United States Mint delaying Silver Eagle release, Perth Mint out of stock, Royal Canadian Mint out of stock, SD Bullion, APMEX, JM Bullion all reporting inventory constraints and delivery delays, physical premiums at 12 to 15% over spot when normal is 3 to 5%. China export restrictions cutting off 60 to 70% of global refined supply. That is not conspiracy, that is data, that is facts, that is reality. Let me show you the bigger picture, because what is happening today did not start today. The silver market has been in structural deficit since 2020. Above-ground inventories have been drawn down year after year. Industrial demand has grown relentlessly while mine production has remained flat. Silver is not primarily mined as a silver mine. 70% of silver comes as a byproduct of copper, zinc, and lead mining. That means production does not respond quickly to price signals. Even with silver at $100 per ounce, miners cannot simply flip a switch and produce more. They would need to expand base metal projects, which takes years and requires massive capital investment. Think of the global silver market like a bathtub. Mine supply is the water coming from the faucet. Industrial demand plus investment demand is the water going down the drain. For 5 years, the drain has been flowing faster than the faucet. The water level has been falling. COMEX and LBMA inventories are that water level, and we are approaching the point where the tub runs dry. This is not a short-term squeeze that resolves in a few months. This is a structural problem that has been building for years and is now reaching a critical inflection point. Now let me tell you what I think happens next. I believe the March contract will experience significant delivery stress. I do not think COMEX will technically default in the sense of failing to settle contracts. They will find ways to manage it. They will encourage cash settlements. They will convert eligible inventory to registered at higher prices. They may implement new rules to limit delivery obligations. But the credibility of the paper pricing system will be damaged. Each time COMEX has to bend the rules to avoid delivering metal, confidence erodes, and that erosion is cumulative. I am not saying the exact 1,980 scenario will repeat when the Hunt brothers tried to corner the silver market and regulators changed the rules to crash the price. But the fundamental dynamic is the same, a gap between paper promises and physical reality. In 1,980, they resolved it by changing the rules and making the market sales only, which meant no bids were accepted, only offers. They could do something similar today. They could impose position limits, they could force cash settlement, they could declare force majeure. But here's the thing, every time they do that, every time they change the rules to protect the paper system, they tell the world that the paper system cannot be trusted. And when trust is lost, price discovery shifts to the physical market. That is when the real explosion happens. The question is not if, the question is when. Now there are 3 types of people watching this video right now. The first type is scared. You bought silver at $90 or $100 or $110. You watched it crash to $75. You are wondering if you made a mistake. You are looking at the headlines calling it a bubble, and you are questioning everything. Let me tell you something. You did not make a mistake. You made the right decision at exactly the right time. The crash you are seeing is not a change in fundamentals. It is a change in rules. The CME raised margins. Leveraged speculators were forced to sell. The paper price collapsed. But the physical market did not collapse. Physical demand accelerated. That is the signal that matters. Hold your mettle. Do not let them shake you out. The second type is confused. You do not understand how the price can crash while demand is soaring. You do not understand how mints can be sold out while the market is supposedly in collapse. You came here looking for answers. Let me give you the answer. The paper price and the physical price are disconnecting. What you are watching in real time is the end of paper price discovery. The futures market is losing its grip on the real market. The third type understands. You have been studying this market for years. You have been stacking physical silver through every crash and every rally. You know what is coming. You are not worried. You are prepared. Which type are you? The paper price of silver crashed 38% this month. During that same period, the United States Mint delayed the release of the American Silver Eagle. Costco implemented purchase limits. The Perth Mint sold out. The Royal Canadian Mint sold out. COMEX registered inventory dropped to 103 million ounces, while the March contract represents 429 million ounces of potential delivery demand. Lease rates spiked to 8%. Shanghai premiums hit 10% over COMEX. China cut off exports of refined silver. 33 million ounces were withdrawn from COMEX in 1 week. Physical dealers reported record demand and multi-week delivery delays. Premiums over spot widened to 12 to 15% even as the price crashed. One of these things is a lie. And it is not the physical evidence. This is what manipulation looks like. This is what happens when a paper pricing system collides with physical reality. This is what the end of a 70-year price suppression scheme looks like. And you get to decide which side of history you want to be on. If this video opened your eyes, if you now understand what is really happening in the silver market, hit that subscribe button because I will be covering every development in this story as it unfolds. Leave a comment and tell me what you think happens on February 27th when the March delivery period begins. Do you think COMEX can deliver the metal? Do you think they will change the rules? Do you think the physical market will finally decouple? I want to hear from you. That is not a market. That is a magic trick. And now you know how the trick works.